Welcome and thanks for watching this Magellan update video, which coincides with the release of our annual investor letters. Today I'm speaking with Hamish Douglass, our Chief Executive and Portfolio Manager. G'day Hamish.
Hi Frank, how are you?
Good, thank you. Question one, the Global Strategy has recently clocked over its 10-year anniversary. Maybe give us some perspective on what you think have been some of the best calls and worst calls over that period?
Well, Frank, I'll be delighted to do that. The first thing I would say, in terms of getting a long-term track record, you're not making decisions every single day. It's relatively few decisions that actually really make a difference, and obviously minimising decisions that actually detract from returns. So if I thought about decisions that we kind of got right over the last decade, I could probably bucket them maybe into 6 different decisions. Obviously, when we started, we have the financial crisis occurring, and we made a very good decision during the financial crisis, just after Lehman Brothers collapsed, to effectively sell all the financial stocks that we held in the portfolio just after Lehman collapsed, actually when the Reserve Primary Fund announced that it was freezing redemptions. And of course that worked out very well. Was it skill? Was it luck? Was it a combination? But that worked out very well for our investors. So I think that was probably the first decision that we got right. Maybe the second decision we got right after that is we had identified big multinational consumer companies that were exposed to emerging markets. They were very defensive businesses, but because of their emerging market exposures, they were growing more rapidly than they'd grown historically, with very high returns on capital, and they were seriously mispriced in that period. And literally right up until 2014, sort of mid-2014, we held a very meaningful portion of our portfolio in mispriced, very defensive businesses, and they delivered very, very low risk but attractive returns. That's become more challenging for us as they've become more expensive and bond rates have hit their sort of all-time record lows, but I think that worked out pretty well for our investors. And then in 2011 or 12, at the bottom of the US housing cycle, we asked ourselves the question is, when do we think housing stocks would recover? And we put a meaningful proportion of our portfolio, nearly 10% of the portfolio, through 11 and 12 into Lowe's and Home Depot, the 2 big home improvement retailers in the United States. We didn't get it perfect. We sold out of Home Depot too early. But we still hold the majority of our Lowe's position, and we've made a substantial amount of money, over 4 times our money in those investments. So taking a long duration understanding at the bottom of a cycle when things were sort of out of favour and unattractive. We've made a portfolio position in, we called it the move to the cashless society. It's a very long structural change in an economy. So we identified that change and understood that it could deliver a multiple of GDP growth for a very extended period of time. And we've held investments predominantly in Visa card, MasterCard and PayPal. It was earlier through the eBay investment, but PayPal's now been split out. And they're almost the gifts that just keep giving. We've made a lot of money in that, but it was the one insight at the beginning. It wasn't through a lot of activity or something. I think our investment, if I went to number 5 in 2014, I think it was, we made an investment in Microsoft. Actually, we made it the largest investment in our portfolio, and it was around $28 a share. This was the end of Steve Ballmer's rule. This is when people thought that the Windows business, the operating system, the PC was going to disappear. Microsoft was ended. Steve Ballmer was very unpopular. He just bought Nokia. And we thought it was fundamentally mispriced, and we thought the fears about the Windows operating system missed a whole series of parts of their business. One that was a network effect business. There are so many programs written in Windows. Windows wasn't about to disappear. They probably had the best applications business in the world with the Office software. They had a fabulous enterprise business, and they had a what was called server business at the time, but it was their transition into cloud computing. And Microsoft has gone, when it was deeply out of favour, since that time has gone from $28 a share to about $70 a share today, and we made it our largest investment. So again, it was a contrarian high quality investment that we had conviction in back in 2014. Unfortunately, you don't get these every few months, these ideas, but when you see them, you have to act. And I think the latest sort of transition of our thinking is our real realisation of the emergence of the digital platform company. And that is something we've really got our mind around in the last few years, and we've got a very meaningful part of the portfolio in sort of these digital platform businesses that include businesses like Apple, Alphabet, which owns Google, Facebook. Microsoft is a platform business as well. And I think they're going to be very, very important for the future of where the world's going. So I haven't mentioned 100 different decisions. I think those 6 decisions themselves have contributed the vast majority of the returns that have been delivered over a decade. So it's not about rapid activity. The second part of the question you asked, Frank, which is a bit more therapeutic here, it's about what we got wrong. And of course we're going to get things wrong over time. We made some early investment mistakes. I call them due diligence mistakes. Hadn't done enough work when we first started out. We had an investment in a weight management business, which is really a meal replacement business called Nutrisystems. It was very early on in the strategy. Before we clicked our fingers, it was down 60 or 70%. That was very painful. You may not see it in the returns there, but it was actually a very painful and a very event we really had to learn from in the amount of due diligence and the barriers to entry in businesses. We made a mistake about a regulatory risk on a business called Sallie Mae, which was a student lending business. They were all in the sort of first 12 or 18 months of setting it up. Not many people would realise this would be a mistake, but when in end of 2008, we went to about 30% cash in the strategy through end of 2008 and into 2009. And everyone goes, absolutely brilliant move. I did the dumbest thing in history. I then converted all that cash into Australian dollars. And what happened was the Australian dollar collapsed from around parity to the US dollar, went into the 60-cent range. And of course, when I wanted to go and when I reached to spend that money to buy global equities again, it was worth a lot less than when I put it in. So I made a great decision of getting out of equities, but then I made a really dumb decision putting into cash. Most people thought the cash was a really smart decision. It was relatively smart, but it could have been absolutely smart. And of course, we've learned from that lesson. People will probably observe we don't hold our cash in Australian dollars when we're holding it for defensive purposes. The most recent mistake was a number of years ago, our investment in Tesco. It's been the single largest detractor from returns over time. We still hold Tesco today. It's a different business from when we made the mistake. Again, it was somewhat of a due diligence error, underestimating the power of the discounters in the market. You don't get everything right. Hopefully we've learned a lot from that. I think I've learned a lot about retailing, and I think it's in a fundamentally different space. Historically, before I set Magellan up, I'd earned a lot of money out of retailing stocks, and often doing things that have been successful for you in the past and keep doing them. The lesson here is what you learn in the rear vision mirror isn't going to tell you how to make money looking out the windscreen. And I think that was really the lesson in investing in some retailers at that point. And the game is changing materially in that space.
So Hamish, there are a lot of commentators talking about the US equity market being overvalued. The strategy itself, the global equity strategy, has some 70% US domiciled companies. Are you taking a concentrated risk on the US market or on the US economy?
Look, that's a very good question, and I think a number of people ask that question. But looking at our portfolio by where the companies are domiciled is a very, very simplistic way to think about what we're doing, and it isn't how we look at it at all. If you look at our portfolio at the end of June, we actually have 22 investments. 16 of those investments are in global multinational businesses. And if I break that 16 down, 13 of those multinationals are in the United States and 3 of them are outside the United States. So that makes up a lot of our domicile listings. We've then got 4 US domestic businesses, purely domestic businesses, and we've got 2 UK businesses in the portfolio, and we've got around 15% cash. So then I would say is let's break it down a little bit. So if I looked at the 16 stocks that are multinational businesses, that represents 65% of the portfolio. I have a business listed in Switzerland. I've got a few in Switzerland actually, but I've got Nestle in Switzerland. I could invest in a multinational food business in the United States, or I could buy Nestle. I'm not indifferent, I just want the best value. I own Novartis, again out of Switzerland, but I could have a multinational pharmaceutical company listed in the United States. I view them as both multinational pharmaceutical or multinational food companies wherever they're listed. In this choice I've got Nestle and Novartis, they're Swiss companies. Okay, but let's look at my tech portfolio. I own Alphabet, which is Google, listed in the United States, but I could own a Chinese business, which is a search business, Baidu. But I've chosen on valuation grounds to own Alphabet. The same thing is I've chosen to own Oracle, which is a multinational enterprise software business. Its closest peer would be SAP out of Germany. Both are fantastic businesses, but on valuation grounds, I've chosen the US multinational versus the German multinational at this point in time. I've actually owned SAP prior to that. So when you look at that part of the portfolio, if you looked at those 16 stocks, 13 being in the United States, if people looked at it simplistically, that would say 85% of my multinationals are US businesses. But if we look through to the underlying earnings of those businesses, 40% of the earnings of those 16 businesses, which is 65% of my portfolio, is from the United States. So clearly just looking at where these companies are listed are not telling you where our actual investment exposure is. If you then come to what I call my domestic exposure in the portfolio, which are these 4 US domestic businesses, that is 15% of my portfolio. So it's actually a very modest part of my portfolio where you could say I've got an economic view on the United States. Yes, I've got 4 businesses. I've got Wells Fargo. That could be a view on US interest rates. I've got Lowe's, which is the home improvement retailer in the United States, a view on US housing. And I've got a few healthcare stocks, CVS and HCA, in the portfolio, those four stocks, 15% of the portfolio. Do I think I bought them at good value? Is it an expensive bet on US markets? Well, the collective price earnings multiple of those 4 companies is around 13.5 times earnings. The S&P 500 is at about 17.5 times next year's earnings. And the MSCI, which are world markets, is around 16.5%. So where we've chosen to be in the United States, we're at materially lower prices than world markets or the US market. So I don't think we're in any way taken a view that, oh, US markets are expensive and therefore invested in them. We've got multinationals, and where we've chosen domestic businesses in the United States, 1, it's modest, and 2, I think there's a lot of value there in what we have selected there in the portfolio. So in no way do I think we have taken, which was your question, I don't think our portfolio is taking a bet on US markets or a huge big exposure to the US economy. I think it's a very modest exposure and where there's a lot of value in that part of the market.
Hamish, there seems to be an ongoing trend towards passive investment. What's your perspective on passive?
Well, let's start at the high level fundamental here on passive investing. I would say the godfather of passive investing, Jack Bogle, he's an absolute hero of mine. Actually, the office adjacent to my desk, and I sit in open plan, is called the Bogle Room. And what he has done is he has effectively commoditised or democratised the beta of the stock market, where you can buy access to the pure market index at a very, very low cost. And I think that has done a tremendous service to society. What you have to understand is investing in an index or even in a smart beta product is it's a rear vision mirror view of investing. So if you take a typical large index of the market, effectively the market is making a number of assumptions when you're investing in that index. It's obviously very broad, and it's really a mean revision story. There's a certain amount of failure in the market, there's a certain amount of super success in the market, and the median business in the centre of the index has been pretty stable, and it mean reverts around its long-term multiples, and effectively that probably grows at sort of the growth of the economy, plus some mean revision, plus you get the dividends on the top, and then you get the winners and you get some losers, and that equation has been relatively stable for a long period of time, and therefore you have historically generated pretty attractive returns relative to GDP growth out of just buying the stock market. So that's what I call the rear vision mirror. If you look, that's the way the world is always going to continue to look. Buying the index is probably going to give you a satisfactory outcome because it has given you a satisfactory outcome. What I would ask people to think about is those assumptions of mean reversion and relative stability through time of the middle of the index, is that going to hold true? Or are we entering in a world where you're going to have a lot more business model disruption and the multiples applying to a lot of companies coming down as their prospects of the future start changing? I think there is a very, very strong case for that, looking out the windshield, not through the rear vision mirror here. So I'm saying is great democratising, lowering the cost of owning the market, but ask yourself the question, what is the market going to deliver you in the future? And are there parts of the market you actually don't want to own and you want to avoid? And that is the big question, I think, here around passive investing. I think this time, to some extent, it is different what the future will look like. There will be more failures in the future than there's been in the past. There's going to be more rapid disruption to many business models in the future, and therefore that mean revision story, looking back through the rear vision mirror, may not be the same story as we move forward into the future. So I'm not anti-passive investing, but to simply it's just going to be easy money and you're just going to get some GDP plus growth story plus dividends out of simply owning the index. I think you need to think a little bit more deeply whether that's really what the future looks like.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching. And as always, feel free to forward the link on to colleagues or clients that you think might be interested. And obviously you can find out more information on our website. Thanks.